In this video today, you're going to learn that if you're waiting for interest rates to drop to buy a home, what that really means. So the pros and cons of each. We're going to go over the payment differences, the possible rate differences, the possible supply and demand differences, and what that means all bundled up so you can keep that in your brain to learn and to plan accordingly. Now, supply and demand will change, which means that you can ask for things now, and you may not be able to ask for those things from the seller if demand increases later. So we're going to go over all that here. Let's get right into it with the FedWatch tool. And if we look at the CME FedWatch tool, you just got to Google that. You'll get to a website just like this, FedWatch. Scroll down. These are all the Fed meetings. Now, the Fed funds rate, which is what we're looking at right here, is pretty correlated to mortgage interest rates and credit card interest rates and things like that. It's just the fee to borrow money from the Fed, and then everything else kind of follows. So mortgage interest rates will go in anticipation of what the Fed is going to do and what the Fed is going to continue to do most of the time. So right now, if we look at the next Fed meeting, September 17th, there's a 90% chance that they're going to drop their Fed funds rate from 4.25 to 450 down to 400 to 425. So that's a 25 basis point cut, as they'll call it. And that's only strengthening, right? So we should see this. There's a 10% chance it'll be even more, which would help interest rates even more. But this is what we got right now. And when we look at the end of the year here, so let's go to October, there's a 73% chance they drop an additional 25 basis points in October. And then in September, in December, there's a 66% chance that they're going to drop an additional 25 basis points then too. So in total, that's 75 basis points that they're anticipating on cutting this year, which should help drive mortgage rates down pretty substantially. So one more thing I want to touch base on before we get into the actual numbers and start pricing out some loans is the 10-year Treasury. So this is a graph of the 10-year Treasury. Now, the 10-year Treasury also correlates with the mortgage, 30-year fixed rate mortgage. So if the 10-year starts to go up, you'll see 30-year fixed rate mortgages also follow and go up and so forth. I mean, it's not just 30-year fixed rate, it's all mortgages. They correlate with this as well. So this way you can see what's happening on a graph. So you see here, it's been pretty flat since, let's call it here, October 2023. It's been basically jumping around 6.5%, 7% up and down. You'll see that there's been a nice dip here because the confidence has been building that the Fed is going to lower their interest rate. So everything's kind of connected here. It's what we watch on our end to see what's going to happen with mortgage rates. So you see this starting to fall below the 50 moving average, which is great, right? The lower this goes, the lower interest rates on the mortgage side should go as well. So that's one thing to note here. But if we just zoom out here, let's go to, you'll see June of 2020, right around there, it was the lowest point in history. And it's way down here, right at almost 0%. So there you go. It's slowly been climbing up, and I hopefully anticipate going down into this range, hopefully this year. We'll see. But let's jump into the actual numbers here. So let's go over, you're going to purchase a home. I'm just going to use Arizona, and these are the factors that we use when we price a mortgage. We look at your credit score. We look at the property type. This is going to be a single family primary residence, which means you're going to live in this house, right? It's less riskier for the bank to lend you money that you are actually living in. It's the roof over your head, so they generally give you more favorable pricing for that compared to investments, second homes, etc. Now, we're going to look at conventional loans, $550,000 purchase price, and a loan-to-value ratio of 80%. So all this means is loan-to-value is how much the home is worth versus how much you're borrowing. So this 80% means that's what your loan amount is going to be versus the price or the appraised value of the home. So you're putting a 20% down payment here. Okay, so loan amount $440. And this is really all it takes. It's credit, assets for funds to close, and income to make sure you qualify and can afford this, and that's all the mortgage is. So if we look at your pricing, which is down here, and this is just a random example, so take it with a grain of salt, but this will show you an idea. What I would recommend in this market since we think interest rates are going to start to come down in the next 365 days, I'd probably put my money on that. I would say, okay, you're buying a home. It doesn't make a ton of sense to spend all your hard-earned cash on that interest rate, because we will call you in the future and say, hey, you can get a lower interest rate for no cost at a later date. So that's the plan of action I recommend for most. Now, as you see here, you have your rate stack, how much each rate costs or the amount of premium it gives you, and then your principal and interest, which is your mortgage payment, not including taxes or insurance or HOA. This is just principal and interest, which these numbers directly control. So you'll see if you choose a higher rate, then we can actually give you what's called a lender credit to help offset some costs. You can use this for title, taxes, insurance, anything to lower your funds to close. So this is something a lot of people don't really understand, and it's important is if you choose a higher rate, you can get some money back in your pocket at closing to help offset some of those costs from the lender. But usually, what most people go with, and my biggest recommendation is choose what's called the par rate, which is as close to zero as you possibly can get. So in this example, 6.49% is $175. It's basically as close to zero as possible. And that makes our principal and interest payment $2,778 a month. So this is our baseline. You want to buy a home for $550, put 20% down, your payment's going to be $2,778. Now let's say, okay, we're going to wait until rates come down, which is a very good point, right? But there's a caveat. A lot of other buyers are waiting for rates to come down as well. So what does that actually mean? It means right now, at least on the West Coast or the western part of the United States, it's a buyer's market, which means selling a home really kind of sucks right now. The sellers are struggling. They want to sell their homes, and prices are starting to settle and come down a little bit. So they have to take less than what they think. So they're taking a haircut. Nobody's happy on the selling side. But if you're a buyer, you can ask for things. So you can say, hey, I'm going to offer you under your list price, and I want some seller credits to help with some costs in the loan, all those types of things. You can ask for that in this market right now. So if we buy right now, this is what I'd expect. However, let's say you wait a little bit, and as rates start to come down, more buyers will come out of the woodwork saying, hey, rates are coming down. Homes are getting cheaper when it comes to financing and getting a mortgage, because that interest rate is the cost to borrow the money, right? So we want to borrow money now because that rate is cheaper. However, you and everybody else in their family thought the same thing. So maybe that home value pops up a little bit because supply and demand. When there's more buyers, there's competition. It's going to drive the price back up, right? So now you're competing against other people. There's more offers. Things are going quicker. This is more closer to what we saw in 2020, where it was mayhem for buyers. They couldn't get their foot in the door. Things were going 50, 100,000 over asking and closing. It was nuts. So let's look at a middle of the road example here. So now you get that home. You've waited for rates to drop. Let's say they drop 0.5%. But what took to get that home that was listed at $550, you had to offer $570. It's an extra $20,000. So what that means is not only did you offer more money, that increases your mortgage payment. $10,000 additional on your loan amount is about $60 a month on your payment. So let's take a look. So if the rates were to stay the same, and we're not going to focus on this because we think rates are going to drop 0.5% for this example, but let's say, all things considered, your payment is now, get that out of the way, $28.79. Okay? And okay, rates are going to come down 0.5%. So let's see, let's go down to right around here is where you'll probably end up. And these would say $0. So the par rate would drop 0.5%. That's why we're looking at this. So make pretend that these numbers are zero. That would make your payment $27.34 to $27.71. Is that a big difference? Let me pull up the first example again. Here we go. So we were at a 2778 at a 6.5. Now we're at a 6 to 6.125 and 2771 to 2734. It's not really a big difference. You waited all this time. You might have missed out on a house. You're offering over asking because there's more competition. You probably can't get seller credits because why would a seller accept that deal when there's so much competition now? So that's at a 0.5%, okay? But let's take it even further. Let's say, okay, what if the home really went crazy and it went up to $600,000? That's a $50,000 price increase over the competition. And again, if we look back to 2020, 50,000 over asking, 100,000 over asking was very common, and that was asking. That wasn't, hey, we're going to list our price $50,000 higher, which could happen. This is just a blanket example at 600. So let's take a look. All of the numbers are still the same. And if it was still that 0.5% rate drop, you would be at 2878 at the 6% or 2917. So holy smokes, my payment went up over 50 grand. Yeah, because $10,000 of borrowing additional on the loan amount is about $60 extra a month for every 10,000. So that's where the numbers go. But okay, what if rates go down even further? Let's say they went down almost 1%, so 5.75. So we were at this 6.5, 6.49, dropped all the way to 5.75 for 0 points, that par rate. Beautiful, sounds amazing. This is probably what I think will end up in the next year or so, maybe a little bit lower, but this is probably my best guess. Your payment's still $2,800 a month, principal and interest. Our original example here, $2,778. And again, when the competition rises, you can't ask for things. So the point I'm trying to make behind this is you make your own decision. It's really hard to time a market, but right now you can ask for things like a seller credits to help permanently buy down the interest rate, which let's jump to example 1 here. Should be this one, right? Let's see. Nope, it's this one here. Let's get rid of all this. Let's clean this up. So this is our first example. Okay, this is your payment. Let's say you ask the seller for 3% seller credits, coming at asking, okay? 3% would take you all the way past the 575 and drop your payment, what's 2778 minus 2568? 2778 minus 2568. $210 a month. And that happens right now in over 50% of the real estate transactions that we're involved in. You come in and ask and you say, hey seller, give me 3%, which is what, 10, 11, 12 grand in this scenario towards my closing costs as a seller credit or seller assist. That drops your payment $210 a month. You get a lower rate on the seller's dime. And if rates drop, well, you already have a low rate. They really got to drop to make a difference for you to refi, right? So there's a ton of things you could do. My recommendation for most people is find the home that you love, price it out with a loan officer that you trust, figure out what your options are. If the payment makes sense, everything makes sense right now, you can refinance later as long as they set you up for success, right? And they don't charge you an arm and a leg now and charge you an arm and a leg later, because the biggest sunk cost is title fees, right? But as you can see, if rates come down and we can get you a little bit higher of a rate compared to that par rate, the lender will give you money to offset those title fees on your refinance. So you can make it really cheap as long as you're set up for success. So that's the whole point I'm trying to make today is this comes up every single day. And if it can help one person out there understand, hey, find the home that you love, see what the numbers are, and don't stress. That's my biggest recommendation, because as competition comes, it's not that fun to go buy a home. You're dealing with a whole lot of people trying to outbid you. Right now, it's slow. So it's a lot more enjoyable. But if you have any questions, or if you have a scenario similar, this is what I do all day, every day. So feel free to check my link in my bio. You can set up an appointment. We can jump on a call. We'll go over all the details. We'll lay it out in front of you so you at least have the information, because the info is power in this case. And that's all I got for you. I'll see you in the next video.